What if I told you that one of the world's largest investment banks is predicting silver could hit $100 per ounce within the next few weeks? And what if I also told you that just a week ago, silver experienced its biggest single-day crash in over 40 years, losing almost 30% of its value in a matter of hours? Welcome to the most volatile, most exciting, and potentially most profitable silver market we've seen in decades. Today, we're diving deep into UBS's shocking forecast, what's really happening in the silver market right now, and where this precious metal might be headed next. Let's get into it. Right now, as of February 11th, 2026, silver is trading around $83.57 per ounce. That's up over 3% from yesterday, but here's what's truly remarkable. Despite recent volatility, silver is still up 158% compared to this time last year. Think about that for a second. While most traditional investments have struggled to keep pace with inflation, silver has more than doubled in value. But this journey to $83 hasn't been smooth. In fact, it's been one of the wildest rides in commodity market history. Just 2 weeks ago, on January 29th, silver hit an all-time high. The exact peak varies depending on which exchange you're looking at, but prices briefly touched levels between $100 and $109 per ounce. Investors were euphoric. Social media was flooded with predictions of $200 silver. And then everything changed. In what can only be described as a market earthquake, silver lost nearly 30% of its value in the biggest one-day sell-off since 1980. The metal plunged from record highs to around $67 in a matter of hours. Traders who were celebrating historic gains one day were staring at margin calls the next. So what happened? The immediate trigger was a series of margin requirement increases by the CME Group on COMEX silver futures. When prices were skyrocketing, the exchange basically said traders needed to put up more cash to maintain their positions. This forced leveraged speculators, many of whom had borrowed heavily to bet on silver's rise, to liquidate their positions all at once. It was a cascading effect. As some traders sold to meet margin calls, prices dropped, which triggered more margin calls, which forced more selling. Market watchers also point to the nomination of Kevin Warsh as the next Federal Reserve Chair as a contributing factor. This announcement created uncertainty about future monetary policy, and in that moment of confusion, investors fled from riskier positions. But here's what's crucial to understand. Unlike a fundamental breakdown in silver's value proposition, this sell-off was primarily technical in nature. It was driven by market structure and forced liquidation, not by a sudden discovery that silver had become worthless or that industrial demand had collapsed. In fact, as we'll see in a moment, the fundamental case for silver has only gotten stronger, which brings us to UBS and their controversial forecast. Following the dramatic sell-off, UBS published research describing the crash as typical volatility within what they call a continuing structural uptrend. They don't see this as the end of silver's bull market. Far from it. According to their latest analysis, UBS expects silver to recover toward $100 per ounce by March, just a few weeks from now. That would represent about a 20% gain from current levels. But they're not calling for a straight line higher. After touching $100, they expect prices to moderate, ending the year closer to $85. Now, UBS isn't alone in maintaining a bullish outlook despite the recent chaos. Citigroup is even more aggressive, projecting that persistent supply deficits and strong industrial demand could push silver toward $150 per ounce within 3 months. Yes, you heard that right, $150. Meanwhile, other institutions are more cautious. Bank of America estimates fair value closer to $60 to $70, arguing that prices had run well ahead of underlying fundamentals. The divergence in these forecasts tells us something important. Silver is at a critical juncture, and even the experts are deeply divided about what comes next. But let's talk about why some of the smartest money in the world remains bullish on silver despite the recent volatility. The answer lies in 3 unstoppable technological trends that are creating unprecedented industrial demand for silver. First, solar energy. The solar industry now accounts for roughly 29% of all industrial silver demand, up from just 11% back in 2014. Each solar panel contains between 15 and 25 grams of silver, and global solar installations are accelerating at a breathtaking pace. In the first half of 2025 alone, China installed more solar panels than the rest of the world combined. The European Union has mandated solar energy integration in new buildings starting this year, and the bloc is targeting at least 700 gigawatts of solar capacity by 2030. Here's where it gets even more interesting. New advanced solar technologies called TOPCon cells actually require up to 50% more silver than traditional panels. So even as engineers work to reduce the amount of silver per panel through a process called thrifting, the sheer volume of new installations more than compensates for any efficiency gains. Analysts estimate that solar energy alone could consume 250 million ounces of silver annually by 2030. Second, electric vehicles. EVs use roughly 2 to 3 times more silver than traditional internal combustion engine vehicles. We're talking about 25 to 50 grams per vehicle, and in some high-end electric cars, that number can reach up to 80 grams. Global EV production is forecast to grow at over 13% annually through 2031. By 2027, electric vehicles will overtake traditional cars as the primary source of automotive silver demand. And it's not just the vehicles themselves. The entire charging infrastructure being built around the world requires massive amounts of silver for its electrical components. Third, artificial intelligence and data centers. This is perhaps the most underappreciated driver of silver demand. The rise of AI has triggered an unprecedented build-out of data centers worldwide. These facilities are the backbone of cloud computing, machine learning, and all the AI applications we're starting to see everywhere. The Silver Institute estimates that total global IT power capacity has increased by 53 times since the year 2000, from less than 1 gigawatt to nearly 50 gigawatts in 2025. That's a 5,252% increase. Every server, every high-performance connector, every advanced semiconductor in these data centers requires silver because of its unmatched electrical conductivity. Now, normally when demand surges like this, you'd expect supply to increase to meet it. But here's the problem. Silver doesn't work that way. Most silver, roughly 70 to 80%, is actually a byproduct of mining other metals like copper, zinc, and lead. This means silver production isn't particularly responsive to silver prices. A mining company does not typically ramp up or slow down production based on what's happening with silver. They make decisions based on the primary metal they're extracting. The result? The global silver market has been in a supply deficit for 6 consecutive years. In 2026, analysts project another deficit of 67 million ounces. Industrial demand is expected to consume around 650 million ounces this year, but total new supply from mining and recycling can't keep pace. This structural imbalance is precisely why institutions like UBS maintain their bullish outlook. When you have surging demand running headlong into constrained supply, something has to give, and typically that something is price. Adding to the supply squeeze, China has implemented tighter export controls on silver. This policy shift is removing metal from the global market precisely when the world needs it most. COMEX registered inventories, the silver that's actually available for immediate delivery, have fallen more than 70% since 2020. We're not talking about a temporary shortage. This is a structural problem that could persist for years. Of course, no discussion of silver would be complete without addressing the risks and the bearish arguments. UBS themselves have warned that silver's recent volatility, which they quantify at 60 to 120%, requires expected returns of 30 to 60% to justify going long. In simpler terms, they're saying silver has to offer the potential for huge gains to compensate for the huge risks. For conservative investors, that risk-reward profile might not be attractive. There's also the industrial demand wildcard. If silver prices remain elevated at $80, $90, or $100 per ounce for an extended period, industries will have strong incentives to find substitutes or engineer around silver's use. We're already seeing this in photovoltaics with copper plating technologies that reduce silver content in solar cells. If this trend accelerates across multiple industries, it could cap the upside for silver prices even if supply remains tight. The macroeconomic environment also matters enormously. Silver thrives in periods of monetary uncertainty, inflation fears, and currency debasement. But if the Federal Reserve successfully manages a soft landing for the economy, if inflation falls meaningfully, or if the US dollar strengthens significantly, silver could face headwinds. Real interest rates, geopolitical stability, and central bank credibility all play crucial roles in determining whether investors continue to allocate capital to precious metals. So where does all this leave us? What's the most likely path forward for silver? The honest answer is that nobody knows for certain. But we can map out a few plausible scenarios based on current data and institutional forecasts. The base case, supported by firms like UBS and JP Morgan, suggests silver will trade in a volatile range between $75 and $100 for the remainder of 2026. Under this scenario, we'd see periodic spikes toward or above $100 driven by supply squeezes or investment flows, followed by sharp corrections when speculative excess gets washed out through margin requirement, increases, or profit-taking. This chop in volatility could continue until industrial demand and investment demand find a more stable equilibrium, possibly in 2027. The bullish case, championed by Citigroup and some independent analysts, envisions silver breaking convincingly through $100 and staying there with potential moves toward $150 or higher. This scenario requires sustained retail and institutional buying, continued supply deficits, and probably some catalyst like a major currency crisis or renewed inflation concerns. Proponents of this view point to the gold to silver ratio, which has compressed from extreme levels near 100 to 1 down to around 51 to 1. If this ratio continues to normalize toward its historical range of 40 to 50 and gold remains strong, silver could see dramatic gains. The bearish case, put forward by Bank of America and more conservative voices, suggests that silver's fair value is closer to $60 to $70, and that current prices reflect too much speculation and not enough fundamental support. Under this scenario, we could see silver gradually decline over the coming months as the speculative fervor fades, industrial demand moderates due to high prices, and investors rotate into other assets offering better risk-adjusted returns. Here's my personal read on the situation. The fundamentals supporting silver are genuinely strong and getting stronger. The industrial demand trends around solar, EVs, and AI are not going away. The supply deficit is real and structural. However, the path from here to materially higher prices is likely to be extraordinarily volatile. We've just witnessed a 30% crash in a single day. That kind of price action doesn't inspire confidence in smooth, steady appreciation. For investors considering silver, the key question isn't whether it can hit $100. We've already seen it briefly exceed that level. The question is whether it can sustain those prices and build from there, or whether we're in for more wild swings that shake out all but the most committed holders. Given the small size of the silver market relative to major financial markets, and given its susceptibility to momentum-driven trading and margin dynamics, volatility seems like the one certainty. UBS's forecast of silver returning to $100 by next month isn't crazy. The fundamental setup is there. Industrial demand is at record highs. Supply is constrained. Investment interest remains elevated despite the recent sell-off. And the macroeconomic environment of high debt levels, fiscal deficits, and monetary uncertainty continues to support precious metals broadly. But achieving that forecast will require navigating a minefield of technical factors, margin requirements, speculative positioning, and sentiment swings. Silver's dual nature as both an industrial commodity and a monetary metal makes it uniquely complex to analyze and trade. When industrial demand is strong but the economy is weakening, what happens to price? When safe haven demand surges but real interest rates rise, which force wins? These are the questions that will determine whether $100 silver becomes the new normal or a brief spike that we look back on as the top of this cycle. What I can tell you is this. The silver market in 2026 is unlike anything we've seen in decades. The combination of transformative technological trends, structural supply constraints, and massive price volatility has created a setup that demands attention from serious investors. Whether you're bullish, bearish, or simply fascinated by one of the most important commodities in the global economy, the coming months are going to be absolutely critical in determining silver's trajectory for years to come. If you found this analysis helpful, make sure to like this video, subscribe to the channel, and drop a comment below telling me what you think. Will silver hit $100 again? Will it go even higher? Or are we due for another major correction? I want to hear your thoughts. Thanks for watching, and I'll see you in the next one.